Post Holdings, ticker symbol POS, just reported Q3 fiscal 2026. They beat Wall Street's consensus on the bottom line, but they completely missed on the top line.
Right.
So adjusted earnings per share came in at $1.78, beating the $1.63 to $1.71 analyst estimates. But revenue was $1.948 billion, which missed the $2.02 billion consensus, and that represents a 1.8% decline year over year.
Yeah.
Moving to guidance, management narrowed their fiscal 2026 adjusted EBITDA range to between $1.56 billion and $1.57 billion.
Yeah.
And despite that EPS beat, the market reaction was just absolutely brutal.
Oh, it was a bloodbath.
Yeah, the stock gapped down, crashing over 12% to set a new 52-week low, right around 78.95 cents on incredibly heavy volume, like 1 to 2 million shares changing hands.
You look at that setup as a retail investor, and you have to ask the core question, right? Like, why did the market so aggressively punish an EPS beat?
Exactly, because usually a bottom line beat provides at least, a temporary lift, or at minimum like a floor for the stock price.
Right, it stops the bleeding. But the answer to this massive sell-off lies entirely in the quality of the revenue and, honestly, a highly cautious forward outlook. The market looked right past that headline earnings number and just saw a business struggling fundamentally with organic demand.
Yeah, so let's open the hood on these numbers and figure out where that top-line weakness actually originated. Because a miss like that doesn't just happen in a vacuum.
Yeah.
The logical place to start is post-consumer brands. That's their biggest segment.
Right.
If you're just skimming the first line of the press release, you might actually think things are going well there. Sales technically rose 6.6% to $974.2 million.
Yeah, but you really have to read the fine print on that revenue growth, that 6.6% increase. That was entirely driven by $141.8 million in sales that they pulled from their recent 8th Avenue acquisition.
Oh, wow.
Yeah, so when you strip out that acquired revenue to look at organic performance like the actual core business, the picture changes dramatically. Excluding 8th Avenue, volumes actually dropped 7.1%.
Man, it's like bragging about your investment portfolio's massive growth right after you deposited a huge check into the account.
Exactly.
It looks fantastic on the summary page, but the underlying assets you already held are actually shrinking.
That's a perfect way to put it. And when you break down where that 7.1% organic volume decline is coming from, the structural issues become really obvious. Pet food volumes were down 7.8%, and cereal and granola volumes fell 5.5%.
And these are not luxury goods.
No, not at all.
These are everyday consumer staples. People still have to feed their pets, right? And they still have to eat breakfast.
Right. And when volume in everyday categories drops that sharply, it tells you something critical about consumer behavior. Consumers are facing sustained pricing pressures right now, and they're reacting by, trading down, finding cheaper alternatives, or simply stretching out the time between purchases.
Yeah.
So that top-line growth you saw in the headline for this segment, it was essentially an illusion bought with acquisition dollars, and it's masking real decay in everyday demand.
So the organic reality is that everyday demand is soft across the board, which really begs the question of whether this is just isolated to the consumer brand segment or if it's bleeding into their other divisions.
Right.
So let's look at food service and refrigerated retail. The food service segment saw sales fall 6.5%, down to $652.9 million, and segment EBITDA dropped 11.4%. But refrigerated retail is where it gets really ugly. Sales just plunged 21.1% down to $184.5 million, with EBITDA plummeting 41.3%.
Yeah, and to understand the sheer velocity of that drop, we have to look back at the lapping of the highly pathogenic avian influenza, or HPAI.
Right, the bird flu.
Exactly. Last year, the avian flu swept through flocks globally, and it created a massive sudden supply shock in the egg market. Basic supply and demand dynamics kicked in, sending egg pricing sky high. Now, demand for eggs is relatively inelastic.
Right, because restaurants and commercial bakeries, they don't just stop using eggs when the price goes up.
Exactly. Food service providers have to buy them to keep their menus functioning. Because of that inelasticity, Post was able to aggressively pass on those soaring costs, which essentially padded their margins during the peak of that crisis.
Wait, I need to pause here and make sure I understand the mechanics of this. You're saying an agricultural crisis, a literal avian flu sweeping through flocks and destroying supply, actually acted as a temporary margin booster for them last year.
Yes.
Like, how does having fewer eggs to sell actually make a company more profitable on the bottom line?
It all comes down to pricing power in a constrained market. When supply drops sharply but demand remains rigid, the price per unit just skyrockets. Post was able to raise prices fast enough, high enough, that the increased revenue per egg more than offset the lower volume of eggs they were actually selling.
Oh, I see.
Yeah, so the spread between their cost and their selling price widened. The elevated egg prices padded their bottom line, creating this temporary windfall. But, markets always normalize. The flocks have recovered, supply has returned to the market, and egg demand and pricing are coming back down to historical averages. What you're seeing in these Q3 numbers is basically the deflation of that pricing bubble. That normalization is pulling those artificially elevated margins right back down to earth.
So essentially the hangover from last year's pricing power.
Right, exactly. And to add insult to injury, refrigerated retail took a secondary hit from the sale of the Crystal Farms business and a shift in the timing of the Easter holiday, which is, historically a massive driver for egg demand.
Oh yeah, Easter's huge for eggs.
Right. But the core story dragging down that 41.3% EBITDA plunge is simply the reality of the HPAI pricing bubble bursting.
Okay, so the American consumer is clearly pulling back on cereal and pet food, and the egg pricing anomaly is officially over. Does their international staple Weetabix provide any kind of safe haven from this domestic volume drop? Looking at the data, the answer seems to be no. Sales were essentially flat, just down 0.6% to $137.1 million. Volumes declined 3.8%, which management attributed to a drop in their private label business. But here's the strange part. Despite flat sales and shrinking volumes, segment EBITDA actually rose 13.7% to $37.3 million.
Yeah, and the mechanism behind that EBITDA increase is entirely engineered internally. It wasn't driven by international consumers suddenly, buying more Weetabix off the shelves.
Right.
It was purely driven by favorable pricing actions and aggressive cost savings from plant rationalization. And when a company talks about plant rationalization, they're really talking about shutting down facilities, consolidating manufacturing lines, and cutting overhead capacity to match a lower demand environment.
Right. So they are essentially shrinking their footprint to save money because the demand just isn't there to justify running the machines at full capacity.
Exactly. Cost-cutting and acquisition math are currently doing all the heavy lifting to protect profitability across the entire company right now. Whether it's Weetabix or consumer brands, management is pulling every internal lever they have because organic consumer demand is just not showing up.
Which brings us to, honestly, the most glaring contradiction in the entire earnings report. If organic volumes are shrinking across literally all these segments, cereal, pet food, eggs, and international private label, how exactly did Post beat Wall Street's earnings per share estimates?
Yeah, it's the million-dollar question.
Right. Let's transition away from the segment revenues and dig into the profitability metrics and the financial engineering management is using to hold that bottom line together.
So we have to look at capital allocation and how they are manipulating the denominator of the EPS equation. But before we even get to the share count, just look at the raw operating margins.
Okay.
Total gross profit decreased 5%, with gross margins contracting to 29.1% from 30.0% a year ago. And at the same time, their SG&A selling, general, and administrative expenses ate up a larger share of those declining sales, rising to 16.7% from 15.7%.
Okay, so the core business is getting less profitable on a gross basis and simultaneously more expensive to run on an operating basis.
Exactly.
Which just makes the $1.78 earnings per share beat look even more manufactured. And this is where the capital allocation shift comes into play, right? Post is a heavily leveraged company.
Very heavily.
They are holding $7.63 billion in long-term debt. Their net leverage ratio is sitting at 4.6 times, with an interest coverage ratio of 3.8 times.
And those leverage metrics really require context. A net leverage ratio of 4.6 times means their total debt minus cash is nearly 5 times their annual operating earnings.
Wow.
Yeah. In a higher for longer interest rate environment, the margin for error at that level of debt is incredibly thin, and an interest coverage ratio of 3.8 times means their operating income only covers their interest payments about 4 times over. That debt service is a massive anchor on free cash flow.
Which is why their next move is so aggressive. Almost shockingly so. Despite holding that $7.63 billion in debt, Post has been deploying massive amounts of capital to buy back their own stock.
Right.
In Q3 alone, they repurchased 2.1 million shares for $198.9 million. And if you zoom out to the first 9 months of fiscal 2026, they've spent $908.8 million buying back 9.1 million shares. They have reduced their total outstanding share count by a staggering 17% in less than a year.
And this explains the EPS beat perfectly. Earnings per share is simply net income divided by the number of outstanding shares.
Right.
So if your net income is actively under pressure from shrinking margins and falling volumes, but you reduce the number of shares in existence by 17%, your per share earnings artificially go up.
Right. The math just works in your favor on a per-share basis.
Exactly. They are using cash, which, by the way, could be used to pay down that massive debt pile to shrink the equity base instead. It creates the illusion of per share earnings growth, even as the actual fundamental business contracts.
I have to challenge the long-term viability of this strategy, though. I mean, it's like a homeowner taking out a massive second mortgage at a 6.5% interest rate just to build a luxury swimming pool to inflate the home's estimate.
Right.
It looks great on paper today, but eventually the interest payments on that debt are going to eat them alive at 4.6 times net leverage. With organic volumes actively dropping, how much longer can management pull the share buyback lever to engineer EPS growth before the debt load becomes the market's primary concern?
Well, that is the exact question institutional investors were asking, and it's precisely why they re-rated the stock downward so violently.
Yeah.
The market is looking at that 4.6 times leverage ratio. They're looking at the volume declines and realizing that the buyback gravy train is mathematically unsustainable. You cannot indefinitely shrink your equity base to hide operational decay when you have a $7.6 billion debt stack to service. Institutions saw right through the EPS beat.
Right, they aren't fooled by the headline number.
No, they recognized it was engineered via share count reduction rather than operational excellence, and they hit the sell button en masse.
And that institutional panic was completely validated by management's forward-looking statements.
Right.
I mean, the $7.6 billion debt load and shrinking volumes directly informed the commentary that ultimately sparked that 12% plunge to a 52-week low.
Yeah, management provided preliminary commentary for fiscal 2027, and it was essentially a warning flare to the market. They're guiding for adjusted EBITDA to be, quote, generally flat against a comparable baseline of $1.48 billion. When a highly leveraged company tells the market that growth is going to be completely flat a full year out, institutional money immediately strips away any growth premium in the stock's valuation. The multiple compresses instantly.
They were surprisingly transparent about the normalization pain still to come, too. Management admitted that their current fiscal 2026 guidance includes about $60 million in food service earnings that are well above their normal $500 million annual run rate.
Right.
So they're essentially telling investors that the recent gravy train from the egg market anomaly is slowing down, and next year's baseline is going to be fundamentally tougher.
Exactly. That $60 million anomaly has to be backed out of any financial models when forecasting the future. But, the flat guidance wasn't just about eggs normalizing. Management explicitly highlighted a whole litany of macro headwinds.
Yeah.
They cited ongoing inflationary pressures, which are still hitting their input costs and squeezing that gross margin. They pointed to higher interest expenses, which is the direct result of recently issuing $1.3 billion in 6.5% notes just to manage their debt stack and refinance maturities.
Ouch.
Yeah. And most critically, they cited, quote, continued volume softness in certain categories.
Wow. So there's the organic demand problem showing up again, in their own words.
Yep. When management goes on the record stating they expect volume softness to continue, and their stated strategy to offset that softness relies entirely on internal productivity initiatives and pricing actions, it signals a deeply defensive posture.
Yeah, that's not a growth story.
Not at all. They aren't talking about capturing market share, innovating new product lines, or expanding their consumer base. They're just trying to protect the baseline profitability by cutting costs and hiking prices on a shrinking pool of customers.
Which leads you, as a retail investor, with a critical question to evaluate. If a consumer staples giant like Post can't drive organic volume growth in every day, necessity categories like cereal and pet food, and is relying heavily on debt-funded acquisitions and massive share buybacks to protect its bottom line, what happens to their strategy if the debt markets tighten further or consumer spending continues to contract? It's a real high-wire act balancing financial engineering against a stark reality of falling organic demand.
It really is.
Make sure you follow the show for your daily earnings coverage.